Hi traders, and welcome to the next video in this course on the bond markets. Once again, we have looked at bonds in previous videos, just like the last one on equities. We have discussed equities before as well, but in these videos what we're doing is just going into a bit more depth into these markets and understanding how we can use them a little bit more in our trading. Even if we don't end up actually trading in these markets, because we are global macro traders, we do need to know what is going on in these different asset classes because of all of the intermarket relationships that we have, especially when it comes to the bond markets. We've talked about this in previous videos. When you've got changes in rates, it has pretty much a direct impact on the bond markets. And then those moves start to filter over to the other asset classes. So, for example, when rates go up, yields in the bond markets will go up. Those bonds become more attractive. You start to see money flowing into that market. So that can impact FX. You could see money flowing out of equities and into bonds. So that's the impact on equities. Same thing with other asset classes that we don't really look at too much, like property. You could see money flowing out of property or money that was due to be invested into property could be held off for some time and put into the bond markets because the yields are that good. And that can eventually have a knock-on effect on things like commodities. So that's why the bond markets are so important. In many ways, the bond market is like the leading asset class, which we'll take a look at. But let's get into this video and remind ourselves of what are bonds. So bonds are fixed income instruments. The reason they are fixed income is literally because you get a fixed return on this investment. The only way you're not going to get paid is if the company or the government issuing the bond declares bankruptcy or defaults on the debt. Now, bonds are typically issued by governments and corporations. When it comes to corporate bonds, there can be different types. For example, you get mortgage-backed securities. These will be issued by the banks who have issued loans or mortgages, but those bonds are specifically tied down to those mortgages, whereas a company could also issue a more general bond. So let's say Apple issued a bond. They could say they want to raise capital. Now, they would outline what they want to use that money for. They'd have a rough outline of exactly how they would use that money, but their business is very broad. So if they wanted it to develop the new iPhone and invest in some new iPhone technology, they could use it there. If they wanted to put it into, recently they've developed their new M1 and M2 chips, their own processors. They could put the money into that. If they want to put it into cloud computing, they could put it into that. So it's quite open-ended. Whereas a mortgage-backed security, it's very much for mortgages. So they're still issued by either governments or corporations, but just be aware of the fact that they could be either quite general use, or they could be for a more specific use. The same thing goes for government bonds. A lot of the time, it's just general use. The government needs to spend money. They won't really specify exactly how that money is going to be used, unless you look at the government party's manifesto and look at what they had pledged, and then you hope that they stick by that pledge. But it would be quite a general bond. However, what we have seen in recent years is in the Eurozone, for example, they've issued green energy bonds or sustainable bonds, and the money raised from these bonds is only to be used to develop green technology in Europe or in the Eurozone nations. So it's still fairly broad because there's a lot of ways you can go about that, but it's more specific compared to the bonds they would normally issue, which could be used for anything. Now, bonds are a way for the issuer to obtain a large loan, very similar to what we said with equities. If you go to a few investors and say you need $1 million or 2 million or 3 million or 10 million, when you're talking about the government, you're talking about potentially billions. It's going to be very difficult to obtain that. Whereas when you do it in the markets, you're firstly marketing to many more investors. You're looking at the international markets and international investors as well. You're opening it up to them. And they can do it in smaller amounts, so it's a lot easier to raise that money. When it comes to government bonds, we know that during times of an economic downturn, the central bank can print more money and they can buy these bonds. So the government doesn't really need to worry then about spending that money because the central bank can come in and buy it. Now, this only works really in the developed nations because they generally have a stronger economy, but also there is a limit to how much you can do that. We've seen a lot of countries that have struggled where they've had way too much debt, and you can't just rely on the central bank to come in and buy it. So examples of that: Italy has a high level of debt. Greece went through a massive debt crisis a few years ago. Very recently, as I'm recording this, Sri Lanka is going through a massive debt crisis. They've basically just run out of cash. So there are limits to how much you can do, but bonds do allow you to raise a lot more money. For governments, it's really the only way that they can sort of loan money or get any sort of debt. Corporations, they can go to the banks and get a loan. They can issue shares and sell the shares for money, or they can use bonds. For governments, they don't really have many other options. And the way bonds work is typically they're going to pay you a coupon on a regular basis. So a bond could be issued and the face value of that bond could be $100, and they'll tell you we're going to pay you 1% per year. So that would be $1 on that bond per year, but that $1 could be paid either once a year. It could be paid in 2 installments. So it would be a semi-annual payment. So you'd get paid 50 cents in the middle of the year and then 50 cents at the end of the year. It could be quarterly as well. It's really up to the person issuing the bond and what they feel is going to work best for them. Now, there are bonds which don't pay any coupons. There could be very short-term instruments. There could be a bond issued for just 3 months, in which case you're not going to issue a coupon, because at what point do you give that coupon out? Are you going to pay monthly? Doesn't make a lot of sense. So those types of bonds will just have a fixed return that they pay you at the end of that 3 months. Now, there could be even longer duration bonds, which may be something like 2 years or 3 years, even longer. And they could tell you, we'll pay you X amount at this time. And the reason they would do that is because they feel like they're not going to have the cash flow in between to pay you coupons, but they will generate a return. So an example of this would be property bonds. This is something relatively new where companies issue these property bonds. So they raise the money from the bonds and they invest it into a property, and then they rent that property out. And the rental yield gets passed on as the return to the bondholders. Now, if they feel like they can't pay enough on a regular basis just from the rental payments, and they'd rather accumulate some of it and pay you later down the line, they could say that, okay, after 5 years, we're going to pay you an 8% return or something on that bond. Or if they didn't use the property for renting and they just wanted to renovate and then sell on, well, in between, they need to use whatever cash they have for the renovations. They're not really going to have any other money coming in. So it's only after they then sell the property that they can actually pay the investors back. So you can also get these types of bonds, but typically there's a fixed duration and you pay a coupon on a regular basis. Now, with the duration, it's usually going to be, it could be just a few months, it could be a few years. You can get bonds that are 30 years, 50 years, even 100 years. You can also get perpetual bonds. So these are bonds which never expire. They just keep paying an ongoing coupon for as long as you hold the bond. And then if you want to try and redeem your initial capital, you'd have to just sell the bond to someone else, and depending on what price the bond is trading at that time, that's what you would get back. So it could be a capital gain, it could be a capital loss. It might just be, you might get the same price that you bought it for. Now, the coupon that gets paid on the bond, that effectively determines the yield. So if it's 1% on a bond with a face value of $100, the yield over a year is 1%. If you get paid that, if it's a 2-year duration bond, then you're going to get paid $2 in total over the course of 2 years. So the total yield is going to be 2%. And the yield is very important because it can tell us a lot about interest rates and the monetary policy outlook, especially when it comes to government bonds, which are generally considered to be the safest bonds in the world, especially US bonds. When you want to measure the level of risk that you're taking with other bonds or other investments, you would usually measure it against the US dollar or something equivalent. So countries like the UK and Germany, where their governments are pretty strong and stable, those bonds are considered to be pretty much as safe as the US treasuries. If there's a difference, then it would be like US treasuries are 99% safe, or let's say 100%, and then UK bonds are 99.9% safe. So there's that very small difference, but they're pretty much on the same level. And sometimes that's easier because you can eliminate the exchange rate risk and it's an easier comparison to make. For example, if you want to make some sort of investment in the UK, then it's just easier to compare it against the UK government bond. Same thing goes for Germany, but treasuries, US treasuries, are considered to be the safest type of investment in the world. And you can measure other investments against it, and the difference in the return tells you the risk premium that you're receiving for taking on that additional risk. So we'll look at yields a little bit more in a moment. The other thing to be aware of as well is the yield at the beginning is not going to be the same yield throughout the duration of the bond. So for example, if a bond is paying you 1% and it pays it on a semi-annual basis and the bond duration is 2 years. Now, after 6 months pass, let's say you want to sell that bond, you sell it to someone else. The person that buys it from you, they're not going to get that 2% yield. You didn't get that 2% yield because when they buy it from you, one payment has already been made because you've sold it after 6 months. So you've got your coupon payment and then you've sold it. So what you'd have to look at is, where is the bond price trading? It's probably not going to be the $100 that you got it for. It could be a little bit higher. It could be 105, in which case there's actually a loss that's going to be made, a capital loss, because that person will receive $100 when the bond matures. And also they're only going to get 3 coupon payments compared to the 4 that they would have gotten if they purchased that bond at issuance. So the yields will change, and when you've got the yields changing on a regular basis, and when you've got all of these transactions with bonds being sold and bought, that's going to impact what the yield is, and all of that is related to the interest rate outlook. Where are interest rates from the central bank going to be in 3 months' time, 6 months, a year, 18 months from now? Where are interest rates going to be? And bonds will need to price that in accordingly. The final thing to be aware of with bonds is they can either be classified as investment grade. So you'll get ratings agencies like S&P and Moody's and Fitch. Those are the 3 main ones, and they rate bonds. They rate the credit worthiness of different companies and countries, and they'll have, it's sort of like a school grading system. They'll have things like, they'll have a AAA, they'll have AA, single A, then B plus, double B, and they'll have all of these different letters. And you'll have to look at each rating agency to see exactly what sort of scale they use. But there's about the top 5 or 6 scales. A bond that fits within those scales is considered investment grade. So it's considered to be fairly low risk, and the person issuing it is supposed to be, they're supposed to have fairly high credit. or a high credit rating. So there's a lower risk of them defaulting on that bond. Anything below that is then classified as junk. So higher risk of default. And when you've got a bond that is junk, it will typically pay a higher yield because it's higher risk. Now, the reason why this is important is because a bond doesn't just stay at the same credit rating all the time, and countries and companies don't stay at the same credit rating all the time. If you look at your individual credit rating, it's going to fluctuate each month or each year based on the information that the credit rating agency has. And the same applies for companies and different countries. So when downgrades or upgrades are made, it's quite important, especially when you get that upgrade or downgrade from either junk to investment grade or vice versa, because a lot of investment firms and things like hedge funds and pension funds especially, because those funds are expected to pay people's pensions, they don't want to take a high level of risk. So they'll have rules in place where, for example, if a bond is classified as junk, the pension fund cannot invest in it. So what that means is if you have a bond that's investment grade and then gets downgraded while you're holding it to junk, the pension fund has to liquidate. They have to sell it, take their money back, and go and invest that into something else that is investment grade. So obviously, if you have a lot of companies doing this and a lot of money participating in these transactions, that means that when something gets downgraded to junk, you're going to see a lot of outflow from that country and from those bonds. So from that market, you'll see a lot of outflow. The same thing goes the other way around. If something gets upgraded, all of a sudden, a lot of companies, a lot of hedge funds, pension funds could look at putting money into it. So you see a lot of inflow into that bond. So if you're trading the bond markets, that's quite important. But for us as global macro traders, we use it more to sort of gauge what the markets think about the future economic outlook and the monetary policy outlook. So let's now move on to the next slide and talk a little bit about how bonds are priced. Now, this is very important because the way bonds are priced is through the use of the present value cash flow model. And this is a model that's used extensively in finance. It's even used to price equities to try and see whether equities are overvalued or undervalued. But with equities, it's a little bit trickier because there's more assumptions that you have to make. Whereas with bonds, it's a little bit more straightforward. So I'm going to do this with an example. We're going to assume there's a bond with a face value of $100. So the face value is basically, that's basically the value which determines how much interest you get paid. So if there's a 2% coupon like we have here, the 2% is on that $100. It doesn't necessarily mean that at issuance that bond will be sold for $100. Most of the time it will be, but the issuer could decide they want to actually issue it at a bit of a premium. So $102. Or they could issue it a little bit lower, in which case you're guaranteed a capital gain if you hold that bond to maturity. So they could issue at $99, but that means that when the bond matures, they're actually going to pay you back $100 rather than $99. So that's what the face value tells us. Now, in our case, this bond has a face value of $100, a duration of 5 years. So the bond will mature after 5 years or expire after 5 years. And you get paid a coupon of 2% annually. We're keeping it annual to keep it simple. So now I've got this table here where we're looking at the cash flows for each year. So this is the end of each year. So let's take a look at what we have here. So you've got years 1 to 5 because the bond has a duration of 5 years. Now, because we have an interest or a coupon payment of 2%, that means the payment in dollars is $2 each year. So at the end of year 1, you'll get paid $2. End of year 2, you get another $2. And so on. And then the end of year 5, you get $102 because you get the 2% coupon payment plus you'll get this $100 back. So those are your payments over 5 years. Now, the way the present value cash flow model works is, what are all of these payments worth in today's money? Remember, when you've got inflation in the economy, you're going to be, your $100 today is not going to be the same as $100 a year from now. If you've got inflation, which means that prices are moving higher, that means that $100 today won't buy you the same amount as $100 in a year's time. It's going to buy you a little bit less, and then even less the year after, and even less than that the following year. On the other hand, if you have deflation, which is a big issue, then the $100 you have now should buy you more in a year's time. So what we're doing here with the with this cash flow model is we are bringing all of these cash payments into today's time. What are these payments worth in today's money? And that helps us to determine how much is the bond worth. Where should it be valued? So, for example, $2 that you get paid at the end of year one, so a year from today. If we say that the discount rate or the inflation rate in the economy, in this model we call it the discount rate, is 3%, then you have a present value of $1.94. So with inflation, or with a return of 3%, that $1.94 will be 2% in a year's time. Now here, we need to do it for 2 years. So $2 that's due to be paid in 2 years. In today's money, it's worth $1.89. And you do this all along. And then you get this total value of all of these cash flows here. And what we've done here is the same thing, but for 5% instead. So based on these cash flows that you're expecting to get in the next 5 years, in today's money, all of these payments are worth $95.43. With the 5% one, it's worth $87. Obviously, because of the higher return, that 87 will go up to the total amount of payments you have is 110. So that's where you can then see, okay, what's your total return? What's the total return you're going to get on these bond payments? So that's the way a bond gets valued. That is what the bond should be valued at. Now, the reason why we're looking at this is not so much because of the valuation. This model does get used to value bonds, but we're not too bothered about that. Firstly, the reason why, even though it is used a lot in equities, because it's probably the best model you can go for, it's not a great one. And the reason why is because here we know our cash flows each year are $2. We know those are the payments we're getting, and the only way we're not getting them is if the person issuing it or the company issuing it defaults on that debt. That's the only way we're not getting that payment. When it comes to equities, it doesn't work this way. You're going to project your cash flows. How much money or revenue are you going to generate in a year's time? How much will it be in 2 years' time, 3 years' time, 4 years? You can't have a fixed number for that. You don't know for sure that this is the amount of revenue you're going to generate. So you're then making assumptions, and what can sometimes happen is the numbers get inflated to try and suggest that the company should be worth more. So that's why this model is quite flawed when it comes to equity valuations. But as I said, it still does get used a lot because there's not really any other real alternative that you can use. But the main thing we want to look at here is the difference in these payments. When we use a discount rate of 3% versus 5%, it's very, very important to keep that in mind. Now, the discount rate that's typically used is the return on a treasury. A US treasury, because as I said, it's the safest investment in the world. So what you're basically looking at is, if I put my money in a treasury, completely risk-free, this is the return I'm going to get. So based on this percentage figure, I want to find out what all of these what all of these values are worth in today's money. Here we're assuming that that number is 5%. Now what you can see is the higher the number goes, the higher the interest rate goes, the more of a discount on these payments. So the value starts to go down. And this explains why when interest rates start to go up, equity prices start to come down. Because if you ignore for a moment the fact that the cash flows that you use in the equity model may not be accurate, if we just assume that we've been given some numbers, they're now not going to change. We're not going to change anything there. Even if you go through an economic downturn, we're assuming that, okay, those are the projections we have, we stick with those. What we do know is interest rates are going up. Now, if interest rates go up, that means that in this model, the whatever values we had, they're now going to go lower because interest rates are starting to go up. So that means that the total value here, the valuation, starts to come down. So when you do this with equities, the price, the theoretical price of the stock and the company starts to come down, which is why stock prices generally come down when you have yields going up or you have interest rates in the economy going up. So this is a very, very important model. And then, of course, the higher the rate, the more money you're going to see flowing out of other asset classes and into bonds, because it's a risk-free investment. If you can get 5% here compared to maybe a potential 8% in equities, you're going to put some money into bonds because you're thinking, well, I can make a guaranteed 5%. I don't need to take too much risk to try and make the additional 3%, but I might put a bit into equities. And if I get that extra 3%, that's great. If not, I'm getting a guaranteed 5% on a big chunk of my investment here. So this is the present value cash flow model. As I said, it is used very extensively in finance. And even though we're not too bothered about the model itself, it's just important to understand what happens when yields go up. It distorts this model and the valuations start to come down, which is why something like equities will start to come down. And then you couple that with the fact that realistically, if the liquidity in the markets, if the amount of money is being withdrawn and there's going to be less spending by companies and consumers, then the projections for the company, they are actually going to come down as well. We're saying for now, let's just assume they remain the same, but they'll actually come down. So you're getting that domino effect coming into play as well. So not only is the discount rate going higher and these valuations are coming down, but they're going to come further lower because the projections are going to come down as well. So that's bond valuations. And the final thing that we want to look at is bond spreads. This is something that gets looked at a lot. You'll see this in financial articles. They'll be talking about the spread, the yield spread between the 2-year and 10-year treasury, or the 10-year treasury and the 10-year bond. So when you compare two different bonds and you compare the yields on those, the difference is known as the yield spread. What's the difference? And the bonds that you're comparing and the bonds that you pick to compare will depend on what is the reason that you're comparing them. What are you looking for? So when you compare the bonds of the same issuer but with different durations, what you're basically looking at is, especially when it comes to government bonds, what are the expectations for the central bank and the economy? Now, usually, if an economy is doing well, if it's in the expansion phase, the yield curve will be getting steeper. So the difference in the spread will be getting larger. So the 2-year bond, for example, could have a yield of, let's say, 2%, and the 10-year yield could have a yield of maybe 5%. So there's a difference of 3% there. Or in finance, we talk about bonds in basis points. So 3% would be 300 basis points. And if we're going through an expansion, then that spread could widen to maybe 400 basis points. So the 2-year bond could remain at 2%, but the 10-year bond goes up to 6%. Now, the reason for that is you're expecting that over time, because the economy is in expansion, the central bank will be tightening monetary policy. They'll be hiking rates. So the higher the rates go, the yields on the longer term bonds will go higher as well. Because you're not expecting that change to happen very quickly in the short term. It's going to be a bit more gradual, so it benefits the longer term bonds a lot more. So if that's what you're seeing on the yield curve, that indicates that the economy is doing fairly well and you're expecting hiking from the central bank. Now, if the spread starts to narrow, then it indicates that the economy isn't doing so well. The reason that the long end of the yield curve would start to come down, the reason the yields would start to come down is because you're expecting that the central bank will need to cut rates. And the longer term rates will be closer to the short term rates. So that's what you're looking at when you compare the bonds from the same issuer but with different durations. You could also compare the bonds of two different issuers. And what I said earlier is quite often you use the US Treasury as a benchmark and you'll compare other bonds to it to see what the risk premium is. So, for example, if you take a US Treasury bond and then you take a corporate bond, like one from, let's say, Amazon, and it has to be the same duration then, because you don't want to, you want to get the correct sort of analysis from looking at them. You don't want to distort that analysis by having a different issuer and a different duration, because then you're not sure whether the yield spread is because of the duration or whether it's because of the different issuer. So you're only changing one factor. So let's say it's a 10-year bond from the government and a 10-year bond from Amazon. Now, the difference in the spread between those two, that tells us about the risk premium. Amazon is going to be higher risk compared to the US Treasury, because the risk you have is Amazon defaulting or the US government defaulting. There's a greater chance of Amazon defaulting compared to the US government. So what is the risk premium you're getting on the Amazon bond compared to US Treasuries? And it might just be something like 100 basis points. But that at least tells you of what you should expect with other bonds. And if you do a few comparisons in yield spreads, you can see whether other companies are compensating the investor fairly for the added risk. Because we've just said Amazon, and we said, what if there's a spread there of 100 basis points? Now, what if you compare a US government bond and you look at, let's say, a company like Moderna, and the yield spread there is 150 basis points. So it's a little bit higher, but Moderna only really came up during the pandemic. Until then, how many people had actually heard of them? And the Moderna vaccine, the COVID vaccine they produced, could be a one-hit wonder. It's really helped their stock and their company in the last few years. But what if they don't do anything after that? Their stock price is just going to go back down. So you're taking a higher risk there, and there's a higher risk of Moderna defaulting compared to Amazon. And all they are giving you in comparison to Amazon is 50 extra basis points. Whereas you might find that another company is giving you 100 extra basis points. So they're giving you 200 basis points of risk premium compared to the Treasury. So you can also make these comparisons to see whether an investor is being compensated fairly, and obviously the one where there's a higher risk premium, or where the investor is being compensated more fairly, that's the one that's likely to see more demand. The other comparison you can make, again, would be between two issuers, but it would be between two different countries. So quite often the the bonds that do get compared are those from the US government and emerging markets. So that could be somewhere like Brazil. Emerging markets are generally considered riskier. Those governments are more likely to default compared to the US government. So you also look at those yield spreads to see whether it's very high or very low. Now, when we compared US treasuries with different durations, a higher yield spread was actually a good thing because it indicates the economy is expanding. On the other hand, if the yield spread between someone like, let's say, the US government and the Brazilian government and their bonds are higher, it's not a great thing. Because it does mean that Brazil is paying a very high risk premium for the bond, but also it could indicate that there's a high level of risk in the economy and less demand for some of those bonds. So it can work in the opposite direction as well, depending on what markets you're looking at. Now, you could say the same thing about the US treasuries, but because you're comparing bonds from the same issuer, if there's a lack of demand, you're probably going to see that across most of the yield curve. So that's why we can say that the yield curve steepening is due to monetary policy and rates going higher and the economy being in a good position. Whereas with different issuers, especially when it's different countries, there's a big risk factor involved there. Now, what if it's not Brazil and let's say it's someone like Germany instead? Germany has a very stable government, so their bonds are considered to be pretty safe. Now, if there's a high yield spread there, you wouldn't really put that down to Germany being very high risk or the economy not doing well. It would be related to the differences in, it will typically be related to the differences in what the Federal Reserve are doing compared to what the European Central Bank are doing. So again, like I've said throughout a lot of videos, and like I said right at the start of this course is only going to lay the foundation. I've just given you 3 scenarios where you've seen a higher yield spread, but it means a different thing in each situation, or a lot of the time it means a different thing, because you've got to put it into context. You've got to look at everything else going on as well. And this is why we said at the beginning, this course is only going to lay the foundation, because the markets are never the same on any given day. There's always change taking place. The markets are always evolving, and you've got to adapt to those conditions. And some of these things I've just explained, they will only come with experience, but it's worth just being aware of some of these factors. So that is bond spreads. Now, the last thing which I said at the start of the video is bonds and yields can often be a leading indicator. And this goes back to the comparison I made between the 2 and 10-year US Treasury bond. Firstly, just looking at bonds, any bond, generally on the short end of the yield curve, it will tell you a lot about what the markets are expecting the central bank to do in the coming months. So for example, if the yield on a bond at the moment is, let's say it's 100 basis points, so 1%, and then about 12 months down the line, it's around 300 basis points. Now, there's a bit of a risk premium there because the longer the duration, the slightly higher the risk, but the issue is the same, so the risk is not a massive factor. What that tells us is, because there's such a big deviation, is the markets are expecting that the interest rates in the economy are going to be significantly higher by that time. So in a year from now, the rates will have been hiked, maybe on a few occasions. And that's what they are pricing in. And investors will, when we're expecting central bank changes, they will look at particular bonds, which you can normally figure out based on some of the articles that you see. You can see what the markets are focused on, which bonds and which durations are they looking at. And you can put those onto your watch list. And you can look at how they change. Now, there'll be a bit of fluctuation each day, but if, for example, let's say a bond in a bond that's going to mature in about a month's time. Let's say the yield on that is 0.25%, so 25 basis points. And then all of a sudden it rises to 50, and the current rate is 0%. When it was 25 basis points, what that was indicating is that the markets are expecting that the central bank are going to hike their rates by 0.25%. When it's gone up to 50 basis points, that indicates the markets are now pricing in a 50 basis points hike, or a 0.5% hike. So these changes can tell us about what the markets think. And what we've seen on so many occasions is those types of changes will happen in the bond markets first, and you'll see the movement in the bond markets. And then there could be maybe, it could just be a lagging factor of a few minutes to potentially sometimes a few days before something like equities and FX start to price that change in as well. So this is why we say that bonds are often a leading indicator. And also, because we're talking about bonds and yields are the rates that you get paid on these bonds, and they will be directly linked to the interest rate set by the central bank. Government bonds generally considered to be the safest assets in the world. Now, the amount a government pays you on a bond is going to be determined by what is the central bank paying, or where have they set their interest rates. And the government bonds will be expected by the markets to pretty much match that interest rate. And then everything else is going to have to be adjusted according to that. If the yield on a government bond goes higher, then you're expecting the yields on a corporate bond to go higher, because you're now getting maybe, let's say, 2% risk-free compared to 1% before. So you're expecting that a corporate bond pays you at least maybe 4% to compensate for the extra risk you're taking on. So interest rate changes, or the anticipation of interest rate changes, will have a very direct impact on yields. And then that all feeds over into things like FX and into equities. So that is bond spreads, and that's this video done on the bond markets. If you have any questions, or if you want to understand anything we've discussed here in a bit more detail, then as usual, send in your questions and I'll cover questions in the daily market briefings. But that brings us to the end of this video. So thank you for watching, and see you in the next video. Cheers.